Drugstores are present in your life in many moments. In the hardest ones, as when you get sick, but also in the happiest, as when you have kids. So why not to expand that list of happy moments by making a profit over any investment on a best-in-class, high-growth, nationwide drugstore chain? Well, good morning. We are the Insper team, and today we bring to you our buy recommendation on Raia Drogasil. At a 26% upside, our thesis is based on three main pillars. RD being the best-in-class drug retail chain in Brazil, its transformational bricks and clicks expansion strategy, and favorable future trends in the sector. Today, RD already leads the sector in terms of store base, being the only one chain relevant in all 5 regions in Brazil, leading both the Southeast and the Midwest, gaining ground by steadily increasing its net openings at a 16% CAGR, well above its competitors. But RD's leadership is also sustained by its unit economics, as an RD store presents 40% more sales and a higher ROIC than its competitors' average. But what makes RD the leader?
Well, it always starts with the best location. In this real example from Salvador, a city in Brazil, we can find a Drogasil on the opposite corner of a Drogaria São Paulo, which is a competitor. Let's look at it from above. Car 1 sees 2 corners in front of it, which makes them positive. And the same goes for car 2, placing Drogasil on a super positive corner. This is important because it increases the store visibility and the odds of attracting customers. But just this example is not enough, right? So we looked up via Google Street View each one of the almost 1,000 RD stores located in capitals, concluding that most of them are on corners and 83% of those are on positive or super positive ones. But just one chain is not enough, right? So we looked up a total of 2,800 stores in order to compare RD to 8 of its main peers. And here is the result. RD wins in 21 out of the 22 capitals it operates in.
But attracting customers is not enough, as 69% of them will turn to competitors if they do not find what they seek, making daily replenishment a key factor which RD achieves through a greater distribution center footprint. Through a traveling salesman analysis, taking a truck total minimum route from the DC to the stores they replenish and dividing that by the total POSs, we confirm RD logistic advantage which mitigates product shortages. So let's sum it up. RD stores catch customers' attention, provide an excellent experience, and guarantee that the customers will find what they want, resulting in higher sales and allowing the company to invest in even better POSs, creating then a virtuous cycle.
Well, being the best in class guarantees RD a 13% market share and 2,000 stores in 2019, making it the sector's leader. But if you know the company, maybe you already knew that. So what else does really excite us about Raia Drogasil?
We've estimated an expansion potential of over 1,400 stores by individually analyzing potential new markets, cities in which another player leads, and where RD is the leader. Seeking to estimate expansion markets, we filter cities in terms of relevance, per capita GDP, total population, and presence of other pharma players, leading to 137 new stores in 64 potential cities. When it comes to cities in which another player leads, RD has shown it's capable of quickly taking over a consolidated market, as seen in Recife, where it surpassed the previous leader number of stores only 6 years after its entrance. And that ability will allow RD to expand in large markets such as Fortaleza and Rio de Janeiro, with 900 projected openings, as it moves closer to leaders in those cities where its presence still fails. Even in deeply consolidated markets such as São Paulo, it still has room to grow. We analyze the coordinates of every main competitor stores in order to find potential greenfields in areas with a relevant market and free of cannibalization, such as Capão Redondo, where the PSP presents 8 stores against one of our additional openings. Much of RD's expansion will take place in lower income areas under its super popular format, which demands smaller capex, are in line with traditional stores above its cost of equity despite lower revenues. This format will boost RD's openings, which will total 1,400 stores over the next 10 years.
Store-based expansion amplifies capillarities as RD becomes closer to its clients and to becoming the only true omnichannel drugstore player, being able to reach all clients' profiles. Click and Collect appeals to those customers seeking the physical store convenience along with the lower e-commerce prices. It is a growing category and increases SSS as 20% of customers spend an additional 60 reais during in-store pickups. Deliveries are done via DCs and stores, with the latter providing faster deliveries. Today, 75 stores already operate as mini DCs, but with the potential for up to 1,000 of those. And while those are important building blocks to become a digital leader, but what really sets RD apart are its data analytics investments. By hiring data engineers and partnering with data firms such as Anhambi, RD aims at truly understand its clients and to develop loyalty. RD also acquired Onofre, a e-commerce benchmark brand which will be maintained as an online-only channel with higher focus on pricing. Apart from that, we also conclude that the drugstore e-commerce segment still has plenty of room to grow. Brazil's behind in developed countries in terms of penetration for the electronic and appliances, but well behind for the consumer health and the beauty and personal care categories.
Well, as we can see, RD's store capillarity allows it to become closer to its customers and to develop the only true omni-channel strategy. Through its bricks and clicks expansion, we see Raia Drogasil reaching a 24% market share in 3,200 stores by 2029. But putting that aside, what should drive value in perpetuity?
Well, Brazil presents a faster population age than many countries, taking the elderly only 20 years to go from 7 to 14% of the total population, accelerating the age pyramid inversion, but also increasing sales, as elders spend roughly 5 times more in drugs. Also, we expect a growing demand for drugstore health services, which will create value for all the sector stakeholders, including us, the customers, who will gain easier and cheaper access to health services. More than that, the demand for exams has been growing at a 7% CAGR. And even though vaccines application has a potential market of 7 billion reais, there are only 3,800 vaccines POS in Brazil, what can be easily captured by the 2,000 RD stores. In conclusion, RD's great capillarity, its solid customer service, and its best-in-class execution capacity will position it well to capture these optionalities in the future.
Well, being the largest and most efficient drug retail chain in Brazil, RD will elevate itself by its bricks and clicks expansion and by capturing future trends in the sector. But how does all of this translate into money?
We have projected 330 bps increase in RD's major same-store sales due to a better competitive environment and a high integration of its omnichannel. Alongside this expansion and maturation, we see a revenue CAGR of 13% in the next 10 years. And since 90% of our start costs are fixed, as maturation takes motion, expressive cost dilution will take place and stores' EBITDA margin will grow. As 40% of the stores are yet to be matured, we have projected 430 bps increase in RD's EBITDA margin. All of this will push RD to a greater cash generation in the long run. We discount these cash flows using the cost of equity of 11%, and in terminal stage, we assume a growth rate of 6%, CAPEX equals DNA, and eliminated tax benefits. We also stress scenarios calculated 47% upside in the bull case and 11% downside in the bear case. By doing a Monte Carlo simulation, we reach a buy recommendation in 61% of all scenarios.
RD currently trades at a 50 times PE 2020. However, there's an implied premium in the multiple as there are near certain additional earnings due to store maturation. By considering that, we arrive at a 32 times ratio in line with high growth retail players. In order to consider bottom line growth, in our analysis, we cited PE to EPS growth for the next 2 years, arriving in a multiple in line with sector's profile.
But how can we be wrong? Our thesis is threatened by many risks, 9 of which we have disclaimed in a matrix. However, we would like to dive into what we find to be the main one. The sector is indeed exposed to cannibalization. Taking this example from a Brazilian neighborhood, we find that stores 1 cannibalizes with 5 of the other 8 stores, which are same chain stores within a 1 kilometer radius from each other. Based on that model, we measure revenue cannibalization rates for RD and its competitors, finding RD to be the most cannibalized. However, this doesn't really concern us, as in our projections, cannibalization in cities where RD already lead will keep in line with historical levels. So, in order to have an increase of 1,000 bps in total cannibalization, that rate in cities where it doesn't lead will have to increase from 18 to 50%, as the majority of RD's revenues come from cities where it leads. Even
1 minute remaining.
Stressing cannibalization scenarios, we concluded that such marginal cannibalization would still generate economic value for all formats, as the IRR of both would exceed the cost of equity.
To wrap it up, now that you know that RD is prescribed to outperform, we emphasize our buy recommendation on the company at a 26% upside. Now we are ready for questions. Thank you very much.
I'll ask the first one. So you barely mentioned the balance sheet in your presentation. Can you please talk a little bit about the balance sheet, especially since it looks like acquisitions and growing the store count is an important part of your thesis?
In terms of balance sheet, Hydrogazil has a historical capital structure, deleveraged compared to other players, which is a choice of the company to be more conservative in order to be more competitive in price and in cases of crisis, as we are seeing today. We all the trouble that coronavirus came to our sector, to our countries, and to our world. So in terms of balance sheet, it has a very healthy balance sheet. It's a sound cash generation company, and it's well positioned to be competitive against all the competitors that did not pursue this capital structure policy of being more conservative and are now today in high leverage levels.
Just adding a little bit, and the company has even provided a guidance regarding its deleveraging position. It plans to go into a net cash position in the future. It does not plan to raise more debt for the reasons that Kyle said. So they really take a very conservative position in that matter in order to avoid crisis. So in a scenario like this one, it proves that it makes sense, even if it's not the optimal theoretical capital structure.
Yeah, guys, when I look at your historical income statement and the pro formas going forward on page 47, you want me to pay 50 times earnings for this business, and I don't see from 2015 through 2019 any margin expansion at all. And it looks to me like your entire case is based on taking EBITDA margins from 7.5% to 11.5%, net margins from 3.5% to 7.5%. That's a lot of growth in margin. And when I go through the line items, you don't get any growth and expansion from cost of goods sold, which is correct. I wouldn't expect that. But talk to me about all of the improvement that I see exclusively in rent, energy, and depreciation. Yeah, I'm getting all of your margin expansion from those. So tell me how those three, rent, energy, and depreciation, are scalable.
Perfect. Of course, when you look at the period that you have told us, it's important to note that the sector was passing through a very unique moment. So the main competitors were raising capital, which concluding them raising their leverage ratios in order to pursue a very aggressive expansion plan. However, in the sector, when you don't do a sustainable expansion plan in order to pursue growth in market share, you start opening not good points. So it's something that Haya has suffered of increase of competition. However, the main competitors, they are downsizing in numbers of stores because they did not make a sustainable expansion plan. And now it's the perfect moment for Haya to mature. It's already is already 40% store in mature base, and to gain share over the periods.
Yeah.
Additionally, you can go, Ronaldo.
Oh, thank you. So as Kyle stated, operational leverage is the main vector for margin growth. So throughout all this period, RD was on a very aggressive expansion plan. So this did not allow for the percentage of mature stores to grow in this period. And throughout our projections, this does happen. So naturally, the revenue per store will grow, and the costs are mainly fixed. So this will cause a rise in EBITDA margin. Also, the company is starting, just last year, it started to invest on its super popular format, which has higher margins in average as it focuses more on generics. And generics in Brazil have a much different price dynamic than in the US, having margins of up to 60, 80, even 90%. So this shift to this new format, which has very high margins, due to generic exposure will also help the rise in margins.
And also,
Just
when
to
it comes,
conclude,
oh, you can go. Sorry.
Just to conclude, the company has been implementing photovoltaic energy power, which means that for the next 5 years, the company will save 20% each year of power expenses. So that also helps the company to gain margins in the future.
I have a question regarding your PE multiple and how that compares to the other companies in your industry.
Perfect. When you look at in the financials, the EV/EBITDA and price to earnings evolution, you can see that higher, it doesn't have many drug retailers public listed in Brazil. There's only one. So which until the moment of the case was not liquid, so we chose not to compare in terms of multiples. So when you can see in this graph, the most dark green line is higher. You can see that it always traded in a premium against the other competitors, which are retailing other premium retailers in Brazil, because Haya is born of a very successful and highly integrated merger, which alongside a very experienced management team could have an execution premium against these competitors. And drug retailers in general, they take longer to achieve maturation. So they take 4 years to mature, while other retailers take more like 2 years to mature. So this has an implied premium, as we told in the presentation, that makes for the premium, the historical premium of Haya be greater than the comparable universe. And you can see also that there is a player which is called Magazine Luiza, that it has grew more than Haya in terms of multiple, because it has been pursuing a digital strategy to focus more in commerce, which is a great part of the value generation of our thesis, is the expansion of same-store sales due to e-commerce and clicks expansion. So we believe that Haya has the possibility to generate value due to the fact that it has this premium that we already discussed, and also is pursuing a digital strategy as the other player that I already mentioned, Magazine Luiza. However, when you go to the other slide, recently, that drug retail player public listed that increased its liquidity has been traded at higher levels against Haya, which now, before the shakeup that the market suffered due to Corona, it has still a premium of Haya over this player, which is Panvel. However, it explained because Haya is historically a better, well-run company in terms of execution, and has a greater potential to grow. It is a national player with a huge expansion plan, and Panvel is a more regional player. And the worst and the best is that it also has a maturation percentage of stores way higher than Panvel.
Okay.
So it seems like much of the company's business model and your valuation is premised on their ability to rapidly expand stores, which they've done historically. To what extent do current conditions put at risk their ability to fund that from operating cash flows?
Also, drugstores are one of the least impacted businesses in this moment, as here in Brazil at least, most all commercial spots except grocery stores and drugstores are closed. So apart from being less affected than other businesses, also—
That is time. Thank you for Insper with a buy on RD. We'll now give the judges a few minutes to take some notes before calling the second team. Thank you.
Thank you very much.